We're talking ETFs with Mike Brown of ETF SA. Mike, let's go back to what we were talking about just before that break. How to get a balanced portfolio of ETFs. Let's start building these now. You would obviously recommend a top 40 ETF, I would imagine. Am I right? So there's your first starting point.
Yeah, if you're going to do your own ETF portfolio, I mean, to go back to your earlier question, the real success in investment is asset allocation. Being in the right assets at the right time. When should I be in property? When should I be in bonds? When should I be in cash? When should I be in equities? There's two ways around that. One is you just go out and you allocate your portfolio. So I want to be 25% in each of those 4 asset classes, and you just sit there for the next 20 years. You're going to outperform anybody, because over time those different asset classes will perform differently. If you've got a shorter term horizon, you're only looking at investing for 5 years or so, you may have to go and start doing your own asset allocation. Now, there's 2 ways of doing that. One is if you go and buy a unit trust. Now, most money in South Africa goes into asset allocation or balanced unit trust, where the manager then selects for you. He says, some percentage of my money will be in equities, some will be in bonds, some will be in cash, and so on. We will very shortly have ETFs that will do the same thing for you. What's the benefit? Well, the ETFs are much cheaper because the underlying cost is so much lower. So you can build your own asset allocation portfolio or use one of our asset allocation portfolios for much lower, because a balanced fund costs you about 4% per annum from a unit trust. You'll be able to do it under our platform for less than 1%. So there's a way of doing it much cheaper. So you either can go and buy the balanced portfolio, the so-called asset allocation ETFs, which we'll introduce the next month or 2. If you want to do your own portfolio, now, I'm not a financial advisor giving advice, nor are you.
Yeah, no, you're very, very right. I'm no financial advisor.
Well, I am a financial advisor, unfortunately, but we're not. I can't sell on TV. That's why I can't sell on TV. I would say, you buy a top 40 index. That gives you exposure to the overall market. In other words, that's what's called a beta fund. The beta is the average performance of the market. 90% of all the trade in the JSE takes place in the top 40 shares. So if you buy an ETF that gives you the performance of the top 40 index, you're getting 90% of the performance of the JSE. So you're capturing the market performance. Now you say, where else do I want to be? Well, if you take the industrial index, the Satrix Indy, that's been the best performing ETF over the last 7 years. In fact, it outperforms something like 95% of all unit trusts. So that gives me a different diversification. I'm just buying industrial shares. There's no resources, there's no financials. I'm just buying that industrial index. Is quite nice. It's all South Africa's biggest companies, South African breweries that I'm sure you've heard of, and Bidvest and all those companies are in that industrial index.
Well, that's why I've got to buy Indy, because I mean I'm propping up South African breweries.
Well, I try, but not as good as you are. So you'd buy the industrial index. So then you've got a overall market, a sector. Then you say, right, I want to diversify, because you want to have something that's going to perform differently to the rest of the market, because that spreads out, reduces your risk over time. When the all shares index is going down, the property index is normally going up. It performs very differently. So you would then diversify into something like a PropTrax, property index. Then you'd say, well, maybe I want to have something that's going to give me specialized performance, either move some of the money into an offshore ETF, which invests in, say, the FTSE or the American market, or we've got an ETF which gives you the world market. Or I go and buy maybe a Satrix Divi, which is going to be a product which says it'll outperform the market. We hope it will, but it's outperformed very well. It's been the best performing unit trust in South Africa the last 3 years, best performing all of them. 700 unit trust, the Divi, Satrix Divi is the best performing fund over the last 3 years. The last 3 years have been tough because the market's been going down, most of it. So now I could just pick 4 shares, put 300 Rand in each. For 1,200 Rand a month, I've got a completely diversified portfolio. I'm doing it myself. As I get to know more about the market, I might say, let's switch one of those funds into something else. Or maybe I get worried about the market being too high, so I want to switch that money out into a money market fund. We'll have a money market ETF on our platform from next month. Money market means you can't lose any capital, but you don't get any capital growth, but you get income at the end of every month. So there's different ways of doing it. It's not all that difficult for you to do yourself. If you don't want to do it yourself, we'll put asset allocation ETFs on the platform quite soon, and that will then make those decisions for you. But then we then have an asset manager, which is not you and me, it's somebody outside who makes that selection for us. Now, he's proved to me, because he has to prove to me over the last 100 years, and these guys all go back with their mathematical models, that his portfolios will perform. And one just hopes that's the case, and one watches it and sees that's the case. So don't be put off. If you don't want to do your own selection, we'll give you a selection product. But if you do want to do your own selection, you can do that. But if you don't even want to do that, just put your money away every month into a top 40 index and just watch it grow.
So you would suggest, and once again we're reiterating, this is not you're not advising from a financial point of view, but one of your suggestions of a possible model for somebody who's entering this market for the first time would be Satric or top 40 fund.
Yeah, buy a top 40 fund, yeah.
An industrial fund, an offshore
fund, yeah.
fund, and
maybe a property fund,
or
the divvy fund,
if
you want to do 5, yeah. If you want to do 5, and that gives you a very wide spread. You know, you're covering the whole market then. Anything you're missing is bonds. Now bonds give you interest, but they don't give you the same amount of capital growth. But if you're an elderly guy, which you're not, I mean I am, you might want to have fixed interest securities, government bonds in there. So that would be your own selection, depending on your age and so on. And we also have calculators on the website that would sort of give you an indication of more or less where you should be looking at in terms of your age profile and in terms of the type of portfolios you should be looking at.
Okay, I'm going to come back to the costs in that in a moment, because a lot of people I think would be interested in knowing what they are. Yeah. What about people who are looking at retirement funds and that sort of thing?
Yeah, retirement fund is something different. You know, retirement funds, the sort of business we've been up until now is where you've discretionary money. In other words, this is after-tax money. You want to save a bit of money. You want to grow your capital and grow your wealth and so on. If you get into a retirement fund environment, you start putting money away which you can't access until you're 55, until you reach retirement age. You can retire any time now. You can retire at 80 if you want to, and you only start accessing your retirement fund at 80. But how do you build up retirement? Because retirement annuities in South Africa have been a disaster. The performance has been pathetic. So we're now going to be in the retirement annuity business. The FSB has given us a license. The ETF SA is now running a retirement annuity fund. What we'll offer initially is we'll offer you 3 different funds. These will be balanced portfolios where you'll be in different types of ETFs. The one will be very conservative. We basically will be looking at just beating inflation plus 3%. The next one will be in the middle, inflation plus 5%. The other one will be inflation plus 7% plus, which will be more aggressive. And we'll give you the option of which portfolio you want to be in. And that will depend on your age. If you've got 30 years to go to retire, you'll be in an aggressive portfolio. If you want to retire in 3 or 4 years' time, you may be in a conservative portfolio. So we'll give you those options.
Who makes that choice, though?
The asset manager. We'll appoint somebody outside. The trustees, because a retirement fund is run by independent trustees.
Okay.
They then appoint an outside manager. That manager then makes the selection. So we're going to start with those funds. We may well, when the Act changes, and there's legislation on the way in South Africa where you can run your own individual retirement fund if you want to, which you can do in America and elsewhere, 401ks or PEP funds in the UK. We'll offer you the option of running your own retirement fund, in which case there are some restrictions on which assets you can't put all your money into one asset. It's got to be spread amongst different assets. It's what's called Regulation 28 compliance. We'll put in place structures where you can run your own retirement fund. But we'll be in the retirement fund industry quite soon. Now, the big advantage is, one, it's transparent. You know what the ETFs are that are underlying it, so you can price your retirement fund every day. Whereas typically, if you're in a retirement fund, you get a letter from the manager saying this is what your fund is worth over the last year.
Right, okay.
In ETF SA or these types of retirement funds, you can look at what your retirement's worth every day. Secondly, the cost structure is going to be very low. A typical retirement fund costs you 4 to 5% per annum in fees. We'll be doing it at about 1/5 of that, something like 1% thereabouts, perhaps just more than that. So the fees will come down. That makes a massive difference over time. If you're paying 5% fees over a period of 20 years,
it's a lot of money.
And you're paying 1%, your money will be double after 20 years just because of the lower fees. Even if we were in the same portfolio, and the one portfolio is having a 1% fee, and the other portfolio a 5% fee, your 1% portfolio, even if it grew the same amount, would be worth more than, in fact, it's close to 2.5 times. So low fees are very important. So we'll have a low fee structure, and it'll be very transparent. So we will move into the retirement fund industry, but that's a different sort of industry. You don't think in a retirement fund, you're putting money away which you can't access. And unless you die, then it doesn't matter whether you can access it, but at least your beneficiaries can access it. So we'll have those options available as well. Now, this is not really rocket science, because if you look at internationally, probably 2/3 of all your money internationally is now going into ETFs or tracker funds, so-called passive funds, not into actively managed funds. In South Africa, 99% of all our investments goes into actively managed unit trusts. Now, we're crazy. Why the foreigners realize that costs and simplicity and transparency and passive investment is the way to go, and we don't realize that in South Africa. So it's an education process, but it's moving along that way. And ETFs are the simplest way of investing in low-cost tracker funds.
Well, I think you've actually answered the question about costs, because it does. Because as far as my understanding is, your problem with trading, whether it's an online trade or whatever, becomes the cost involved in the trade itself. And so you need to be in a position, and correct me if I'm wrong here, you need to be in a position to know what you're going to be buying so that you're not making a whole lot of changes, because that's going to cost you money.
Yes, normally if you buy a share through a stockbroker, he'll charge you 1% brokerage, and there's fees from the JSE, which is about 25 Rand a trade. So if you're going to invest 1,000 Rand, it's going to cost you 125 Rand in brokerage. If you come to the ETF SA platform, we'll charge you 1 Rand brokerage. Everything covers the JSE fees, because we bulk. We trade on behalf of a whole lot of people. So that transaction trade is much lower. If you want to switch, get out of one ETF into another, you would still only pay that 0.1% brokerage charge, and that makes a massive difference. So trading costs are one part of your component. Second part of your component is having somebody to manage the portfolio and so on. But by being in listed securities, which ETFs are, you're now on an electronic register. So any shares you own, whether you own 1 share or 1 million shares, it's registered in Jeremy Mansfield's name on the normal JSE straight register.
Okay.
And if you want to change that and sell that, it's on that register electronically. We can check within 5 seconds if you own that share, and we can sell it for you. And we can then register whatever you buy in that. And ETFs are on that. Most of your other products in South Africa are over-the-counter traders. So if you want to trade a Sanlam product, you've got to go to Sanlam and trade it. And if you want to get out of Sanlam and buy an Allen Gray product, you've got to sell the product at Sanlam, take the money, go to Allen Gray and buy it from them. Now, that's where your costs are. So those transaction costs, which are very high. Once you're trading on the stock market and you're doing it in bulk, we can then bring down the transaction costs, because we're just trading on one market. You're trading on the JSE, which has got 600 shares, and whichever of those you're going into, you can trade relatively simply if you go through a platform like ETF SA, which bulks it. We only do ETFs, but our trading costs are significantly lower. Our annual administration costs are typically lower than a stockbroker as well, but you've got to make money somewhere, so there are some costs in there. But any trading, any transactions you do on ETF SA won't cost you more than 1% per annum in fees. If you bring us big amounts of money, then the fee comes down. If it goes over a couple of million, then the fee goes down to half that. So the costs are not the big factor. What you really need to do is just make sure that you invested for the long term, because the stock market doubles every 4.5 years. So 1 Rand becomes 2 Rand, becomes 4 Rand, becomes 8 Rand, becomes 16 Rand. If you just stay invested, that's the best thing you can do.
Yeah, it's what everyone said. If you want to get into equities, you've got to be there for the long haul. Don't take a short-term view on it.
Take a short-term. If you do have a problem, it's a tradable platform. You can sell some of your securities. You can say, I own 1 million Rands worth, I want to sell 500,000 Rands worth. You can do that. Best thing to do is just stay in there. And if you stay in there in the right sort of ETFs, you're going to outperform, I think, over time, virtually any other investment asset that can be offered to you by the professional industry. Now, they're there to try and outperform. They're there to look after your interests. But ETFs are the way, that's a man in the street way of investing.
Mike, thank you very much.
Thank you.
Thank you. It's been great talking to you.